To the morning bell for September 25th, 2025. I am Keith Harwood here for Yellow Tunnel and Tradespoon. Normal disclosures before we get started. Options involve substantial risk and are not suitable for all investors. Tradespoon, Yellow Tunnel, and myself are not investment advisors and not registered with the SEC nor FINRA. If you do have questions about your own personal financial situation, please consult with a registered financial advisor. The information in this presentation is for education and information purposes only and should not be considered trade advice. And finally, myself and or the team at Tradespoon or Yellow Tunnel may have a financial interest in the securities presented and the trade ideas. So please keep that in mind as you evaluate anything that we discuss for your own personal investment or trading portfolio suitability. All right, well, with that, we are pulling back a little bit. So yesterday started a little bit of a pullback, today getting continuation on that. We had some unemployment data that came in lower than expected. Normally I would say, okay, well, that's good. That's a good sign for the economy. Fewer unemployment claims. That should be a good thing, right? GDP revised or came in high. So things look positive from the economic standpoint, and yet the market's taking it as a negative input. And I think a lot of this just has to do with expectations for what the Fed's going to do going forward. We're at this weird spot with a bull market that is taking good news as, in my view, a question of whether the Fed will lower rates aggressively. And so if the economic data isn't weak enough, and the market is potentially overvalued here, I think we all kind of accept that. We got high valuations right there. So if the driving element of the bull market is Fed policy, then good news may not actually be good news. And we've seen this a lot in times when we're coming out of like a recession. So coming out of the subprime crisis, for example, bad news was good news because bad news meant interest rates weren't going to be raised, that we were going to keep interest rates at zero forever, and the market could just keep growing based upon a low interest rate environment. Now the question becomes, well, if we're not going to be getting that bad of data from an economic standpoint, do we now need to bring down the value of the individual companies because we're not going to lower interest rates as aggressively? You know, that's my interpretation at this point. Maybe it shifts. Maybe we start getting good earnings data to justify current valuations. That's a month away, or at least 3 weeks away to get started again, start looking at the financials and things. So the market is not sure what to do, really. And so the natural decision point is, well, but I guess I'll just reduce some risk here, pull back a little bit, and now we look for support levels. And this can set up some of those put credit spreads again. VIX a little bit higher. Now we're getting closer to support levels. So it makes it a little bit more now, because we didn't get the follow through, of a put credit spread market once again. So that's that probability of success trade. Are we turning into a falling knife, or is this a dip that needs to be bought again? This market's been trained to buy the dips. The dips have gotten shallower. We're getting close to our first support level. And if that breaches, do we go into a falling knife? Or do we go to just the next support level, 2-3% away? Tough choice, right? An evaluation needs to be made to determine, okay, well, if we're not going to be lowering interest rates as aggressively, and we'll double check on the Fed expectations here into the end of the year, then what? How does this shift investment allocation and decisions that are being made? I'm certainly not looking for return on capital trades right now. Again, the bull case just isn't paying the bull in most cases. You get those chase trades, the ones we've discussed, the IONQ, the Micron before earnings, Baidu, Baba, et cetera, these things that just went parabolic. But the rest of the stock market just kind of sat. There were a handful of names. There wasn't just the few that I mentioned, but there's not a huge just grind higher for every stock. We've seen that in the MMFI, which we'll again look at today. We see that in the individual charts, the individual sectors as we go through. There are a few names that were kind of grinding higher into a trend, the GE type setups, the JP Morgans, the Morgan Stanleys. There were stocks that were spiking, and there were stocks that were sitting. And now we start looking for where that support level starts to set up. Is it going to be a bull flag or is it going to be a falling knife? And we're indeterminate at this point. We may be going falling knife. We may be going into a dip buying opportunity. More likely than not, it's going to be another dip buying opportunity, just because that's been the trend, that's been the pattern. But if that dip buying opportunity doesn't work, it goes back to that, that mentality that you kind of hear the pundits say is, oh yeah, buy the dips until it doesn't work. Okay, so if this dip doesn't work, if the buying of the dip doesn't work, what's the exit point to know it doesn't work? What support level do I need to stop out at? And then where am I re-engaging? Because it may just be a bigger dip, 3%, 5%, maybe it's 10%. Maybe it's not just the 1 or 2% dip that we've had before. Long-term holder might just say, you know what, getting chopped up a lot, selling when we go down 2% and then trying to buy a new breakout to all-time highs, getting 1% there, and then we pull back 2%, and I'm actually losing money in a market that's going higher because I exit near the lows and I enter back in near the highs, and that's the chop scenario. It's frustrating for the bull. Now the person that's anti-bearish has still been doing fine there as long as they've got enough room so they don't have to stop out of the dips. Selling lower put credit spreads for lower premium, for higher probability and lower return on capital. Are we doing a trend change here? This is now getting to that point where we've had a few days in a row of red days. Or is this just part of the process? That's the question we have to ask ourselves right now and try to determine. I think today's price action will be telling. Open interest on the put side is generally low. People have been re-engaging, buying those puts, buying that hedge. That's why the VIX hasn't been going up, or has been going up and hasn't been going down. And now that feels justified for the put buyer, even if they were paying a higher level than they probably should have been at all-time highs. In terms of implied volatility, now that feels right in hindsight. It felt wrong 2 days ago, but now it looks like the right play after all. For now, is there enough hedge on the market that they can buy the dip? I would generally say probably yeah. How would I be hedging right now? How would I be fading the break or the dip? These are the questions that we got to ask. So if I'm fading the dip, I'm looking towards put credit spreads. If I'm hedging the dip, more likely just buying puts or put debit spreads, and we'll evaluate that on a case-by-case basis, because with an elevated VIX, it's hard to just pay the premium, right? Buying puts and selling calls at least reduces my Vega exposure, and it takes a little bit more delta off, but it means that if I was planning to buy 5 puts to hedge my portfolio, maybe now I buy 3 puts or 4 puts and sell 3 calls or 4 calls. I have the same net delta impact on my position by buying fewer puts and selling some calls as well, but without paying the premium, without paying the high VIX. Because if we do end up with just the same thing we've done before of recovering after a dip, buying the puts hurts a lot. Buying the puts and selling the calls can end up being a neutral. So if I'm looking to hedge right now, it's a risk reversal. If I'm is a generally good idea, in my opinion. Things can shift next week. We've got non-farm payrolls next Friday. That may be a trigger point for continued downside, or maybe a trigger point for resumption of the bull trend. Maybe somebody from the Fed says something about this not necessarily impacting their view of interest rate projections, and maybe that's enough. But we've got to be, flexible, as always. Be flexible. 2 days ago, looked like everything needed to be executed on the bull side. Still maintaining some cash just in case we get the pullback. Well, now we got the pullback. Maybe it was only a 10% chance or a 20% chance of the pullback, but we got that. There's always a chance. There's always a reasonable expectation that we get a pullback instead of a continuation. And this is the case where we got that pullback instead of the continuation, in spite of seemingly good economic news. So I think it tells a lot about the mentality of the market, looking for, struggling to see reasons to buy with equity valuations high, And a lot of it's still, as I said, my interpretation is that we're built based upon Fed expectations of continuing to lower rates and doing so aggressively in order to help continue to inflate this market. And if they don't feel the need to lower interest rates, then what? Then we're built off of earnings data. And if earnings aren't good enough and valuations are high on independent companies, then we don't have that boost coming from lower interest rates, and we have to just trade based upon valuations, and valuations are high. So that's where we're going right now with this market. 10-year yield, bit higher. Again, expectations here, maybe a little bit less aggressive lowering of interest rates. Tested 4.2, seem to be rejecting that for now. If we push through 4.2, we go back to that 4.2 to 4.35 range, maybe up to 4.4. Maybe this rejection pulls back. I don't see it breaking 4% without some really bad information next week on the economy in the form of non-farm payrolls. We've been talking MMFI, the number of stocks that are really looking bullish. And yesterday it was about 60%. So we're near that low of the range of the last month and a half. Bull market, I'm looking for this to be above 70. So it shows that lack of participation broadly. It dipped yesterday because the market dipped. So a few names that were above the 50-day moving average came below. But it's a very selective market on the bull side, or more selective than one would normally see at all-time highs a couple days ago. 70, 75, maybe pressing 80 to show a really overbought condition where we're buying everything. And instead, it's been just loading into a couple of good ideas, or so it seems. And then Bitcoin. Risk on barometer, down 2,000 points today. Testing that 100-day moving average again. Trying to see if we can make a new low for the week. Big support, if and when we break the 100-day moving average, big support is around 108. Bigger support is at 102, 103. It's a bit concerning right now. We're at that inflection point again. If we show continued weakness today, more risk off, get below 110, I think it's coming with a market sell-off in that scenario. But if it comes on its own without the market sell-off, another 1,500 points, I think that's an indication that people are just avoiding risk right now, and we've got to take that for what it's worth. So first, before I go into the stock market, let's go to the Fed Watch. So the CME has this nice Fed Watch tool. The expectations yesterday were 92% probability of a rate cut. Now it's 83%. There's some uncertainty about the next rate decision now. As we go into the end of the year, here we go. We had about a 75% chance of 2 rate cuts. Now it's down to 60%. So still the odds on for 2 rate cuts, but more uncertainty here. And uncertainty doesn't sit well with the market. We like that certainty. We like what we saw a week ago. 82% chance of 2 cuts, 90% chance of 2 cuts, something like that feels a lot better for the market because we know what the Fed's going to do. 92% chance of that rate cut down to 83%. Expectations are shifting and starting to put into question whether or not these rate cuts are going to go through. The data from the last month pushed us towards saying another rate cut. Went from 43% to 83%, or to 92%, and then now back down to 83%. And again, it's a lot easier for the market to just buy when they don't have to worry about the Fed, and the Fed is doing something that is generally constructive for the market. All right, so here's the market itself, down half-ish%. The lows on September 17th, 654.30, 3 points away, about 0.5%. So we're still holding. It's not a falling knife yet, but it is 3 red bars in a row. And I give a little bit less, weight here to the red bar on September 23rd because that was just unwinding the September 22nd move. So Monday up, Tuesday back down, but inside, almost inside day. We had a slightly higher high, slightly lower low, basically the same range, but closed inside the range from the previous day. Kind of unwound the September 22nd rally. Yesterday started showing some weakness. Today showing some follow through off of that employment and GDP data. That was good. And the VIX is now over 17. So this VIX is now at the high point outside of a little wiggle up on September 2nd, that Monday, we're basically at the highs of the last month and a half, 2 months. August 1st, we had a spike. September 2nd, we had a spike. And we got non-farm payrolls next week that put a little bit of question mark for the market. Do I want to wait to buy until the non-farm payrolls data comes out, or do I want to trade something or invest ahead of that? I think from the longer or midterm investor thesis, they may say, I'll just sit it out for another week if I've already been sitting it out. Or I may take a little bit more off now ahead of non-farm payrolls just in case it comes in at a level where we reduce the odds of another rate cut further. So we have to watch the charts to see if that is what comes through. And if it isn't, and if people start buying this dip and pushing back towards unchanged, then all right, great. I can get re-engaged and reevaluate on maybe Tuesday or Wednesday of next week. How much exposure do I want to have going into non-farm payrolls? Do I want to hold for, 5-6 days to try to get another 1% or 2%, which is possible to the upside, but risk that we may drop a little bit further. Now, again, I wanted to touch on a couple of other levels here. So 655 is a level that I'm watching. I'm watching 650, the previous high before the breakout at the beginning of September. And then below that, I'm looking at 635. So we've got some support levels that can hold. It can be really meaningful. 6,500 is usually going to be a big level. So 655 is kind of a light level. 650 certainly seems like a big level. That was the ceiling. Now it becomes the floor. But again, that's 7 points away. That's a full percent. And in a generally lower volatility market, a percent has a bigger, feels a lot bigger than a percent back in April, when a percent was just feeling like a tick, a minute of trading. We're getting into a little bit calmer market. And frankly, in about 3 weeks, 4 weeks, we're not going to see some of the rest of this major volatility on these 6-month charts anymore. So people that are looking at 6-month charts, this is, by the time we hit November 9th, so a month from now, this chart's just going to look good on a 6-month chart. By the time we hit October 23rd, a month from now, we're going to stop seeing this just from the visual, not looking at the wild early April, mid-April stuff. So, and there's a certain element of that from the psychological standpoint that says, okay, I don't see it anymore, and so I start to forget about it. People looking at 3-month charts may already have forgotten about it. People looking at longer term charts, certainly not going to forget about it. Go out a year and you see all of this negativity from February through April. But when I go down to 6 months, I'm just seeing the tail end of it. So, just the visual can have a psychological impact, and we have to keep that in mind as we evaluate the stock market on the whole. Anyway, IWM down 3 points, down 1.25%. Small caps certainly not feeling good today. 10-day moving average not holding. 20-day moving average testing the break. So a good inflection point to watch here for small caps. We're below the trend line, and we are below the 10-day moving average, and we are now testing below the 20-day moving average. Next natural landing point, there's some justification, I think, of this 235 range, but really I'm looking all the way down to the 50-day moving average at 231, another 7 points, another 2 to 3%. And I don't think that happens without the S&P getting below 650. It's hard for small caps to drop 3% when the S&Ps are only down 1%. So if small caps are going to be an indication of that, that's a problem. Financials that have been trying to break out, now they're trying to just trade a choppy range, 53 to 54.5. So we're near the lows of the range. I'm not looking for Morgan Stanley calls anymore. We've now pulled off of that in the last 24 hours. Yesterday on the open, it looked like just a general, okay, great, ride the trend, buy some calls, let it run. buy some call verticals because we were going into earnings. Looking at the October 17th term, I'd have earnings premium, so maybe buy and call verticals there, or calls with a shorter expiration date. Now it's starting to move more towards the put credit spread and using 152, 151, 150 range as our main support, 3% lower. Goldman, same kind of thought, right? JP Morgan, a little bit better, but similar thought here is that at some point, if Morgan Stanley and Goldman are pulling back, they're going to pull down JP Morgan. They're going to pull down Citigroup, which has already pulled back a little bit, and Bank of America, which I was becoming a bigger and bigger fan of, particularly 2 days ago. Now it's looking more like a put credit spread with 51 being support. And again, there's an opportunity there as long as this market stabilizes. Do I want to be exposed to non-farm payrolls with next week's 51.50 put credit spread? Maybe. This week's 51.50 put credit spread, not enough premium. We only have a little over 24 hours to make that trade, 11 cents. Sure, it's a 10% return on risk, so for 2 trading sessions, that might be okay. But to do a trade like that, I need to see the S&P stop falling. And as we watch this just intraday, the fall continues here on the open. Once this support is found and the short-term charts start to show a bounce and some engagement from the bull, that's when I can start looking at the full credit spreads. But until then, I'm just watching S&Ps and saying, okay, 655, we should see some hold. If 655 doesn't hold, then it's hands in my pockets for the buying side. If 655 does hold, and we jump, like if we go down to 655 and then bounce back up to 656 and a half, 657, I have the confidence that this is a dip to buy for now, for the short term. If we breach 655, hands in my pockets until I start seeing some buying again. So right now I'm waiting. I'm not going to have that first 1/10 or 1/4% maybe on the bounce back. Well, let somebody else do the heavy lift, and then I'll jump on board once they're doing the heavy lift and bring this market back around. XLV. So these stocks are now starting to break below their support level, but credit spreads may not look that great anymore. So now it goes back to, again, saying, okay, well, maybe I need to exit now before they start to go to a liquidation mode and then re-engage if and when this market recovers. So the ideas behind the put credit spreads may be correct, but I have to determine how quickly I can move. Exit now, re-engage later. That seems like the right answer. I mean, Micron, same idea. Yesterday, it looked like it was going to hold that 160 level pretty well. Now it's below yesterday's low. So exit now and re-engage later, because if we start getting into a falling knife, I'm really concerned that stocks like Baidu and IONQ are going to get much bigger hits here. That Rigetti is going to just get into liquidation mode. It's only down $2.50 today. It's only where it was on Monday, Tuesday. It's not that bad. If I was selling the rally along the way, I might have been selling some at 22, some at 25, some at 28 and a half. Still feels pretty good if I've been bullish and long since 18. Today doesn't feel good, but the long term still feels good. And again, if we turn around and start bouncing back up and set up bull flags, then re-engage at that point. We're not going to see a bull flag today, barring some new news. Somebody comes out and says Powell says we're still committed to a rate cut in a few weeks. But without that, I don't see us going back in the green today. So I got to take into account that today is more likely than not going to be a red day. And just how do I want to manage a red day? Will Bitcoin hold above 60, right here at the 63 level, right at the 100-day moving average for IBIT? If so, I can look at a put credit spread into a bounce. So it's 31 cents right now for the 63.62. Maybe I end up selling that for 22 cents later in the day on a bounce back. But I'm not looking to engage right here unless I'm just doing it with stock, so I have an easy out. And what's my out? Frankly, maybe 62.34. I don't want to put on a multi-legged spread, even a put credit spread, and have to deal with potential liquidity issues if the market goes from down, nearly 1% to all of a sudden down 2%. We can start to lose liquidity in the individual names when the market's down 2%. And yeah, gold is starting to pull back. And I actually think that's the one that I'm like now more convinced on the bear side. Now, maybe not for tomorrow, maybe not even for next week. Maybe I have to add a little bit more time. But FXY, look how weak that's been. That is now at lows outside of July 31st. That's a bearish indicator for gold. UUP up another 9 cents today. The dollar testing the highs. These would normally be bearish indications for gold. And if interest rate cuts are not coming, that reduces the argument for the bull in gold. So again, maybe all of this shifts away. October 17th, it feels a bit expensive, but gosh, the leverage potential for a downside move here makes some sense to me as maybe even a hedge for the market. So usually, a lot of times people look at gold long as a hedge for market exposure. Right now, I think they're trading a little bit more in line with each other, and gold should reverse with S&Ps if the rationale behind the rally and the rationale behind the break is Fed policy. Again, TLT, as we know, is going to be down today, another 11 cents. It's not a ton, but it's drifting down here into the range of like where we were at the beginning of August. And GLD is still screaming high relative to that level. Beginning of August, 315. So still 10% higher than that. SLV, actually still up today. And the downside here looks like it could be as low as 35.5, $5. 10, 13%. Gold, potential downside, 8, 9%. Implied volatility here is 16.7. Implied volatility here is 27. So gold downside still looks more attractive to me than silver, but they both look potentially interesting, even though silver made a new high today. All right. So on the bear side, I think that's my preferred bear trade. Bearish, if I want to have something bearish, go to the precious metals. I go to the miners. I go to something like that. GDX at the beginning of August was trading 55, now 72. It's 20% downside if these things go just hand in hand with gold and silver and interest rates and the dollar and everything else here right now. So a little bit of concern there for those potential downside risks in the precious metal space in particular. Now, if everything shifts around and we start going bullish again, then I'm wrong and all these gold and the market go up. But I'm not re-engaging then with the long side of gold or the long side of miners because I still think that those are too high relative to where the rest of the market is. I look back at some of the other names that have been bought and maybe got a little bit hit harder than they should have on this current break. Maybe it's an NVIDIA. Maybe NVIDIA can actually get above 185 on a rotation within the bounce. Remember when we were rotating within the bounces over the last few months, it's been out of tech and into small caps. So I've also got to be watching that closely. Is tech going to be the bounce back buy, or is small cap going to be the bounce back buy? Over the last few days, tech had started to get some leadership. Again, today, similar to the S&P, testing down towards that 20-day moving average, big support around 583, another 1% away, similar to the S&P. Small caps worse than tech today, which are both worse than the broad market. Because like the Dow Jones Industrial Average is only down 0.4%. Yeah, I'll just use the ATF just to stay consistent here. DIA, here we go. DIA hadn't been getting nearly as bought up. It's not as people have not been as aggressive buying into the Dow Jones Industrial Average. So there's less positioning to reduce here. So it's only down 0.4%. People are reducing what they've been buying. And that goes again to semiconductors, down 2% today. So those things that were working are the things that are not working today. long and short of it. All right, the longs that were performing the best are the things that are getting hit in many cases, outside of maybe MSTR, which couldn't catch a bid, and now it's below the support levels. You know, HUD 8 is down 7%, but still holding above 34. Marathon down 5%, but still holding, no, actually that got below 17, but at least holding above the previous breakout, barely. Riot getting hit a little bit here, down 5.5%, but still holding above 16.5, the recent lows. But MSTR is just apparently the worst of the breed here, well below support levels, while Bitcoin is still above support levels. Is that an opportunity, or is there something structurally wrong with MSTR? I don't know, but I guess if we get above 320, then I start looking at put credit spreads again. You know, but I got to get above 320. I got to get back above support. I got to see IBIT rallying. And then above 340, I start looking at calls. So down here, I don't see anything. Above 320, put credit spread. Above 340, calls, maybe call verticals. And in the other names, it's dicey play. Because, I mean, IONQ at 70 bucks, again, last week, or sorry, not last week, a couple weeks ago, it was trading 45. If we go into falling knife, that has so much downside, so much risk to it. We're not going into the growth stuff that probably needs low interest rates to have cheap debt. Then these names, even though IONQ had their own fundamental story as on top of it, that can get unwound real quick. So be cautious is my my net of it, I guess. So I just want to look at JD here. Yeah, so just can't get above the 200-day moving average. All right, let's go through the aggressive power trader names because those are going to be interesting today. You got Aflac breaking out, insurance company, seems fine. So that is not part of this market pullback. Could be part of that move to safe haven stocks. Actually, I should check DexLU. I have not checked DexLU yet today. The utility's holding up. So people are kind of going into some of those safe haven stocks, and insurance companies often fit that bill, as do communications companies. That's fine. But overall, I think Aflac maybe just looks like it's okay. Will it go bullish in a market break? Will it go bullish in a market rally? It's unclear. Implied volatility is kind of mid-range at 18%. Realized it's been 15. You know, it's kind of a tough one where if I wanted to sell a put credit spread, I'd look at like the 107, 106 for next week. That's a dime and it's not liquid. So it may just be better suited with Aflac to buy the stock. And if we get below 109, we'll say, pitch, walk away and reevaluate later. Upside may be 113, 114. So it seems like a good entry point on a potential breakout here. But with the lack of liquidity in the options already, and if that liquidity gets worse because of a market liquidation and Aflac gets pulled down with it, I could be in trouble trying to exit. I have a lot easier time getting out of stock. Medtronic, pulling back aggressively today, big dip, but held the 50-day moving average. Again, so maybe this is a good spot for a put credit spread. You know, 92, 91, 24 cents. Reasonable liquidity, outright options, not great, but onto a spread, I could probably get pretty close to 24 cents, 23 cents, maybe 22 cents. Just got to watch to make sure that that is going to hold. Today's low was 92.72, and then we bounced off of it. Intraday, you know, how aggressive was that dip? It was right on the open in the first 5-7 minutes of the day, and then started bouncing back. So showing that, you know, maybe MDT didn't need to be sold that aggressively. There was a little bit of a move out of it, but it's not the same as the, you know, IONQs of the world. This is up a couple percent, 3-4% over the last month or two. So it doesn't seem to have nearly that money in right now that it has to get out. And then MPC. All right, so this is back to the USO story, right? USO down today. rejecting the highs again. The bull in oil, once again, so far, not being rewarded. Maybe that shifts in the next couple of days, but right now, the breakout hasn't occurred. And I've been avoiding these oil names. Now, MPC may be the biggest, the best looking chart within that oil space right now, but I think we need to have the backdrop of bull oil to really get these things moving. And I'm likely just going to end up missing MPC. But if I'm missing MPC and oil starts bouncing around or bouncing back, I look at ExxonMobil. Huge resistance at 116, big level there. We get through and oil's breaking out, then I can try to play ExxonMobil instead. It's bumping up against resistance. It's at a great inflection point. I haven't started a trend yet. I haven't over allocated into the name. Chevron maybe, same idea, 162. We get above that, it starts to show a little bit more bullishness, getting into new high territory for the last 5.5 months. Not to the highs of 6 months, maybe it only goes to 168, but these are alternatives to going into MPC on the thesis that if we push oil to new highs, MPC may just be getting too high for me to be able or willing to buy into it. But I can use the fact that MPC has had money flow to look and say, okay, that identified a sector to me that's been generally bullish. XLE, as we know, has been generally trying to break out. It hasn't gotten there yet. OIH has tried to break out, now pulling back in. XOP has tried to break out and now pulling back into the range. So there's going to be a lot of stocks within that sector that can be attractive from a bull case. Identified by more as much as anything, looking at just some general money flow over the last few days. And then on top of that, looking at MPC independently being pulled up in aggressive power trader. Yeah. All right, so let's shift over because you asked about it. MU. My support right now is a little bit light here at 155. We broke some of the previous support levels. I was looking for it to hold 160. It didn't happen. Looked good yesterday on the close, looks bad today. So now I just have to get down to the intraday chart. 155 looks like a better support level. If for those that had already sold some put credit spreads and got hurt a little bit on it, I wouldn't blame you for saying, never mind, I got to just hold off on this for now. Wait for it to bounce back to give me a little bit more confidence, get back above 160. There's a light interest potential here to buy in with a 155 support. I can go real short term. I can get some leverage. It's an elevated implied volatility here for the day on the 160s or a 160, 165 call spread for 80 cents. I know it's only selling 33 cents, but 33 cents is probably too much for the 165 calls. I can get a decent amount of premium for the 155, 152.5 put credit spread for 70 cents. Yesterday we were looking at the 160, 157.5 for, I believe it was about 70 cents at the time. Now that's about $1.60. So that doubled in value. And it may bounce back into that range in the next hour. But right now we're showing once again, it looks like there's some buying here after the original opening sellers. I could certainly see a bounce back to 160 today. It makes the put credit spread, the 160, 157.5 start to look good. Makes the 155, 152.5 put credit spread look good. Makes the 160, 165 call debit spread look good. What doesn't look good is just, to me, outright buying 165 calls. That's an unlikely payoff. What doesn't look good is just selling a 150 put. That's not a good risk reward, because if we go liquidation mode, I never like selling naked puts anyway, but in particular not when we've got a stock that if it gets below 155 could fall off a cliff down to 140 or 143. So I think approaching it with some near at the money, either put credit spreads or call debit spreads, depending upon how aggressive you believe this bounce back can be, is the general right approach. I don't want to buy 150 puts. I don't want to sell 150 puts. I want to use that as a hedge, for a put credit spread, i.e. the 155, 152.5 put credit spread or 155, 150 put credit spread. I'm only in that scenario buying this option to hedge the liquidation risk associated with selling the 155 put. It's just, you know, a safety measure for the tool. Independent of anything else, buying or selling the 150 put is either way can be a bad trade. Sellers, because we could get liquidation and you could have that really big negative return. Buyers, because it's frankly probably not going to happen. So just buying that as my naked put buy, it's not that's not a place that I would want to be buying naked puts for tomorrow. Same idea is that I don't want to buy a 165 call expecting Micron to run up out of this. That's even less likely, it seems, than the 150 put, even though they're priced about the same, being with one being $7 away and the other being $8 away. So I think staying near at the money, and you know, just managing as we see fit. Like you know, like I said, a 160, 165 call vertical would be an interesting play for 85 cents, or for next week, the 160, 167.5 call vertical. Maybe go a little bit higher. Implied volatility still has some room to fall here post earnings if the market's going to be bouncing back. You know, for a bull case, that's $2. We go back to yesterday's close, it's about $2 in the money. All right, so it should be worth about $3. And then I don't have to worry quite as much about non-farm payrolls by selling a deleveraged put credit spread. So, you know, I'd be torn between buying a call vertical for tomorrow versus selling a put credit spread for tomorrow. I think that's more than anything about what kind of style one prefers in their trading account, because, you know, the implied volatility for tomorrow is still elevated, but we're getting a little bit more movement still. You know, 2.5%, 3%, that's a 48 vol. That's what we've got for tomorrow, or we got a little higher than that for tomorrow. We're closer to 4% expected moves on a daily basis. But as we start bouncing back here, I think that that's maybe okay as a spot to try out, and maybe it's a close by the close or close below 155. You know, we go below 155, I got to get out of either one of those. If we go to 162 today, probably take off either one of those as well, just to book the money and move on. And if we're still sitting here, the put credit spread will have collected some theta, the call debit spread will have reduced some value by theta. So that's, I mean, a lot of that just comes back to watching this market and saying, okay, are we bouncing or are we just stabilizing? And right now, I guess it looks more like stabilizing. You know, try to bounce back, pull back a little bit. Try to bounce back, maybe we go to 590.5 and then maybe pull back a little bit, or maybe we do go continuation of 592. Up at 592, I have a lot more confidence in buying the dip in general. So, yeah, I think with MU, it's, as I talk through it, I mean, I think I'd probably lean towards the put credit spread. I still think that might be a decent approach, but the one from yesterday is not working. So do I want to keep loading the same position, or just let that, I mean, maybe holding that position from yesterday, letting it bounce back, maybe a break even here pretty soon at this current rate, you know? Needs about 160.5, 161 to get back to a break even on the first trade. That's interesting. Schwab's up 1% today. That's an interesting setup here with Schwab finding support again at 91.5. Probably not enough premium for tomorrow, but yeah. Gotta clear the, it's got a filter on somehow. Nah. Nothing to do here on Schwab, I don't think, unfortunately. You know, maybe it could go into next week with a 91.90 put credit spread for 17 cents. It's just under 20% return, or just at 20% return on risk. It's okay, it's not great, but at least it's not liquidating. It's finding its support here at 91.84, right? Today's low was 91.92. So finding support around that 92 level, looks like the real support should be 91.5. Didn't really fully push through it, didn't push through the 100-day moving average. Maybe that's a good sign there for something away from the tech side of things. JP Morgan's actually in the green now. We going into buying all of these financials again? Appears so. All right, so Bank of America again. Just watching the market dynamic here in the first half hour, I start going back to Bank of America. The weekly power trader idea from the beginning of the week. It's up on the day. People have basically said, okay, financials were not what we should have sold. So let's go back in there. They're not saying the same for semiconductors yet. They're saying it a little bit, but they're still red. They're not saying it really for IONQ. That's still below, that's now below 70. IWM down 1.25%, QQQ down here. So IWM versus QQQ has bounced back kind of in tandem, but financials on the whole look like they are one of the first sectors that people are willing to buy here. So maybe it goes back to just that right now. The Bank of America 51.54 or 51.55 call spread that we were talking about yesterday, buying a 65 delta call. Man, there we go. 63 delta now for the 51s. Selling a 20 to 30-ish delta call, so 54, 54 and a half. And saying the market's still willing to buy into these financials, so that still suits, that still works. Speaking of weekly power trader, GE tried to break here and is bouncing off the 10-day moving average. That's starting to show some decent sign here. Getting above 300 will be key because 300 is always a big number in any of these stocks. Our paid trade is down a little bit right now. We're looking for that to bounce back with some calls there in October, but we're getting back close to the opening level from Tuesday, the closing level from yesterday. Maybe we get back above 300 today and people start reallocating there. GLW, that's got some work to do to get back. It's trying. Again, looking to get above yesterday's low as an indication that the market's still okay with this. Because again, we didn't have bad news driving the downside. It's what's their Fed reaction to seemingly good news. And so the initial reaction was, well, if the Fed can't lower rates, I got to lower the stock market. But now it seems like the response reaction is, well, yeah, but the economy's better, so I guess I can go ahead and buy back in. I just have to pick those stocks and then find where that money flow is going. And it looks like right now it's financials as much as anything, and some of the names that we were identifying through weekly power trader. GM testing the highs still. Google I didn't really like, and I still don't like that. But on a bull flag, maybe it sets up. That would be like a tomorrow trade. Close near here, tomorrow trading 245, I can look to buy to retest the highs. And SMH, as I said before, a little bit weak here, but if it sets up a bull flag, great. And if it just continues rallying today, then I go over and look at an NVIDIA or a Micron or something that in that familiar semiconductor space that's got some potential for upside. What's Palantir look like? Bouncing off the 10-day moving average, back above yesterday's low, approaching yesterday's close. All right, so looks like, half an hour in, the trade thesis is buying the dip. So that starts to shift things for me. VIX still elevated. Skew slightly elevated, but not coming up quite as much as the VIX has been. If it was like 64, I'd say that put credit spreads can't be sold, but maybe put credit spreads can be sold here with a VIX at 17 and SKUDEX only up a little bit. Especially since people have continued to want to buy puts into rallies. Maybe there is a justification there of selling the put credit spreads or buying stock and doing the risk reversal, because skew still sitting at around 145. I'm looking for this to see puts come up and calls come down, and right now calls are just not coming down. The entire engagement on the hedging side of things has been put based. People have not been capping their upside, not been setting the financing of the puts. They've just been buying the puts. Yeah, I mean, a little bit of a minute by minute reevaluation of the market, but right now it does look like financials are being deemed safe. FXY still weak. Gold not rolling over. It's like Taiwan weak. South Korea a little weak. So some of those Asian markets are still on the dip side of things. TSM down 2.25%, but still holding above 265. I don't know. All right, so yeah, think about this a little bit more. Let me quickly just touch on Costco earnings, and then I'll come back to some of the other macro stuff going on. Costco earnings today after the close. Normal move is about 2.5%. We've had a lot of variety here, 0.5% up to 7.5%. Hard one to trade the earnings on here, frankly. $950 stock. 2.5%, we're talking about $25-ish. 7.5%, we're talking about $75. I mean, a natural landing point would be $100, but that has nothing to do with the normal earnings analysis, right? That's 2 standard deviations. That's right in this range. Open interest on the options. It's kind of all over the place, except for the big 1,000 strike open interest. And then on the put side, pretty spread out, 942.5, 940, 935, 925. I don't see a natural pin here in Costco. I don't see a trade there right now. And we should touch on ACN. It did the, lower probability, small move. 1.5% down here right now. Testing some lows here, but we talked about this yesterday. It's been a 7% move, effectively 4 of the last 8 times. And this time it got a much lower move than normal. The put butterfly has a little bit of value left, not a ton, about 15 cents. The call fly is still worth about 8 cents. So net maybe 20 to 25 cents. So not a winner right now, not likely to be a winning trade by the close tomorrow. Unfortunately, not one of those trades that generated the 6 or 5x return. Maybe a coin flip for now. I would just be, I'm just looking to take the exits and reduce the total loss. There's always a bit of incremental risk in an earnings play, but right now ACN didn't do what it normally does, unfortunately. Only 1.5%, a quarter of the standard deviation, if not less. So tight range for ACN today. Maybe there's something that sets up with it in the future, but for now, I don't see a trade in ACN. I did not mention STX. Let me pull up STX. Got slow loading on the data today. Touching the 10-day moving average. That's my intraday. Okay, so I think for a stock trader, just using today's low as a stop out is a $30 stop out at today's low. So lean long, I would lean long for the moment since we bounced off the lows. Look for the bounce back that seems to be coming through with financials starting that process. And then if that shifts back to bearish, and we'll see it, with Qs, we'll be back to down 1% instead of down 2/3% right now. Clearly getting some bounce back here. Then I got to look for the bear side in that scenario if the dip resumes. But right now the dip is being bought. So, in that scenario, like I said, I think looking for the For the options players, I think starting with either put credit spreads or like micro on the 160, 165 call vertical. I think those are both good. The 55, 52.5 put credit spread or the 60, 60 and 60, 65 call vertical. The call vertical probably pays off if Qs get back up to like 594 or higher. So there's a little bit of momentum that needs to continue here on the bounce back. The put credit spread just needs to see everything stabilize. My confidence in this bounce back is growing though, for sure. You know, we're now at session highs. Just a little more room to go to really get that confidence built, make a new session high, and people may start to get more aggressively committed to the idea that, oh God, that was the dip to buy. That's all we're going to get. Time to get in. Don't miss the bounce back. So today's high is 592.39. We're right there. A little bit more, and all of a sudden, I think we could start pushing. Actually, maybe can get back to unchanged today after all. Maybe the initial reaction was just a head fake. It's just wrong. Palantir's green now. Apple's green now. All right. So I think through the day now, it's just finding those names for the dip buy. That's Micron. That could be MDT. Could be GE. Could be Bank of America's already gotten green here, but that, you know, if not already in, I think that makes some sense here since financials have been the first spot to be. So rather than going into the names that are already part of, you know, in that bull trend, Bank of America was identified as a potential catch up here through the weekly power trader. And so, yeah, that like 51, 54.5 call vertical looks like a really just solid trade right now in Bank of America. CSX from yesterday, above the 50-day moving average, starts to look like 36. It's not a huge, I mean, it's still 7, I guess, 8%, 7%, 7%, 6 to 7%. MUR from yesterday was with the oil names. Yesterday Murphy, today Marathon. So again, I'm building that potential here off of USO, and USO hasn't gotten to a new high yet. So until I see USO back to yesterday's opening or closing price at the least, I don't want to go engage with XLE, XOP, OIH. But if they do, then I think ExxonMobil becomes a natural spot to check out, or CBX, names that have some resistance here that we're approaching. All right. GLW is bouncing back too. That's good to see. So GLW, again, I want to see that above yesterday's low. Yesterday's low was 79.06, so we're right there. Yeah, so we'll see how that goes. Still don't want to touch IONQ. I don't want to touch Baidu. I don't want to touch BABA. Yeah, I guess, you know, that's kind of it for me right now, honestly. You know, it's a little bit of it's a bit of a dynamic market to watch throughout the day, frankly. You know, buying right now has its risks associated with it, with the elevated VIX, but it's working right now. Q's making new highs for the session. S&Ps at session highs. Yesterday's low is another big trigger point, is 659.67, so about a point away. And all of a sudden, if we start turning green here, we may end up with that big spike, and you know, all of a sudden everybody says, gosh, why didn't I buy that dip? Because the market really is starting to reward the dip buyers, but may get more aggressive with it here in a moment. I think that's where I actually, as I say that, I think that means that for the structural buying here, the Micron call vertical for one day, it's got some good leverage to it still, even at current levels. The 160, 165 is still only a buck. You know, that could be a triple or more for tomorrow if this is a real bounce back and we get more aggressive. And then not only focusing on the bull case, but also focusing on the anti-bearish dip buying case saying we don't have to go up, but I can sell maybe a put credit spread in MDT by the wider vertical in Bank of America. That's not just a 1 to 1.5 trading session trade. That can be held for a little longer. Heck, going to just making it very simple, SPY, and selling a 655, 654 put credit spread for today. Expires on the close worthless, and I collect a quick, is that 13%, 13 or 14% for the day, and I don't have the overnight risk. Because at this point, the market's starting to tell me that we probably won't make a new low today. So I sell that for 13 cents. And as long as we stay above 655, I'm in good shape. And if we go below 655, yeah, I'm going to lose maybe 30 cents on that, 20 to 30 cents. But right now, that feels like a safe concept. And I don't want to do like something inside today's range. I want to trade it based upon today's low, which was also the 917 low, or a little bit above 917 low, right? So for the very short-term trader, actually just put credit spread, same day expiration using those daily options actually can work really well. I just have to factor in pattern day trader risk, because if I have to exit it, it counts as a pattern day trade. And so you have to have an account over $25,000 if you're going to have more than 3 day trades in a week. So you don't want to get your account locked up making trades on same day options if you have a smaller account. So a smaller account, let's say a $10,000 account, I would traditionally go and say, all right, well, I'm going to sell a put credit spread for tomorrow, maybe a little bit lower, so that I feel a little bit safer. 654, 653 for 20-ish cents, 18 cents. But then I can have the overnight hold and avoid the pattern day trading risk. GLW, yeah, so I'll come back to that, Ted. Yeah, so with GLW, the way I'm looking at it right now is it is not yet great, but at least it's showing some support here. It needs to get back above the 10-day moving average. It certainly does just have a market beta right now. Yeah, trying to get to a 1-day chart. There we go. All the selling was right on the open. Since then, the support has been 78.25, so we're about 50 cents off those lows. Right now, a little bit of selling came in. Yeah, I'd like to see it get back to like 79.5 to give me real confidence for tomorrow. Right now, it's just not there. But if the market's going to continue this bounce back, I expect it to happen. So for GLW, the long position is really built on, I think, tech market beta at this point. Tech market continues to recover. GLW will just be part of that. It's one of those things where, if not in, I'd probably just go to QQQ. If in, I'd hold it if I wanted to buy QQQ. So like if I'm in GLW, I like the QQQ bounce back, so holding it. Not rotating into QQQ, because then I got to cross markets twice, once to get out of GLW, once to get into QQQ. Just accept the market beta of it and expecting it to move kind of in line here with the Qs in terms of this recovery from today's dip. But if I don't have GLW on, I'm not looking to buy that independently today until it gets back towards 80 or something like that. And around 79.5, 80, maybe I can justify going and crossing the markets a little bit to buy GLW and be a little more selective than just buying QQQ. But I think a lot of this market behavior right now, outside of like maybe financials, is just going to be market beta in a lot of these other names. Financials maybe look like they're performing a little bit better, so there's a certain rationale to going that direction with like the Bank of America trade, as opposed to buying IWM. I'd rather buy financials than IWM. But in a lot of these tech names, generally can just be applied via buying QQQ if they're not trading really separate from them. Palantir may actually be on its own starting to trade a little bit differently, or Nvidia, as they're going green ahead of the market. So they're leading the market bounce back. All right. And let's just double check where GE is now. So GE, still about $1 away from looking particularly good here, but again, I think it's more market beta than anything. Gold's actually green now. I see no logic behind this gold move. Ugh. Oh well, I mean, I still haven't re-engaged yet. I've just been banging my head waiting for the opportunity, and I should probably re-engage on the bear side. But if the market's bouncing back, maybe the easier trade is just to say, you know what, I'm just going to ignore gold, ignore silver, focus on the other market stuff that makes more sense to me. So logically, I think gold should drop. Maybe I can say that can be a hedge to a bullish S&P position, because if it is purely built on Fed interest rate expectations, if we are lowering the odds of a rate cut and the S&P starts to drop as a result, I expect that GLD should drop with that, off of lowered expectations of rate cuts. So if that's my trigger for a bear move, then gold is a short, along with as a hedge to the market. And then if something else comes out as news that's unexpected that causes the market to drop, it may be a bullish gold, bearish S&P. But if I think that the main risk for gold, for market downside right now, is Fed policy, then I can hedge that by being short a little bit of gold and hoping it doesn't work, just hoping the market continues to rally, as opposed to making the primary contrarian view in gold my main position for my portfolio. I think, small trade right now that may work out, and maybe it just doesn't. IBIT is bouncing back, but that's a good sign. Okay, so yeah, we're getting some buyers at a dip. That seems to be the net result of what we're seeing today, and that should work for a lot of the bullish trades. But I think the put credit spreads for more than anything being held for more than a couple of days, looking at put credit spreads outside of like maybe Bank of America. And the short-term trader can look at some calls or something for a leveraged return on the thesis of a market getting back to green. SPY down 30% here for the 560s. Or 660, sorry, 75 cents. Ugh. $1.70 for tomorrow. That's probably not a buy. All right. $1.70 versus 29. Can you rally that fast? Sometimes I'll go look at this as like a calendar opportunity, and it's a little too elevated with the implied volatility of 10%. I like those short-term calendars, like the 2-3 day calendars when you get these daily options, but I like those a lot better when this implied volatility level is at like 7%, which that's going to be more likely when the VIX is at 14%, not 17, 16 and a half. But it's good to start seeing that come down. The confidence in the dip buy is certainly increasing. Less is my answer on QUBT. So yes and no. I actually now would like to just see IONQ pull back more aggressively. I think that with the market just giving this broader dip, and seeing some of this money flow in like financials and stuff, those are just easier trades, easier to buy. QUBT rallying as like a derivative of the IONQ and rest of quantum space looked interesting, but I think there's more stuff now starting to get clearer within that like financial space to say, okay, I can just go into financials, not XLF necessarily on its own, but that like Bank of America just looks a lot easier and a lot lower risk and a lot less mentally taxing. So yes, QUBT can certainly run here for those looking for like a more volatile name. Rigetti already almost back to unchanged. IONQ getting a nice bounce back. QBTS, how's that look? So the rest of them are all in pretty good shape. So yeah, I mean, QUBT could get to 22 today, 22 and a half. I could certainly see that. If this market turns green, I expect that this can get 8 to 10%. So if we're looking for like a stock trade with some high volatility, high beta, that could be an interesting place to be. For those looking for something safer, I mean, the financials seem like the safest place to be right now. All right. QUBT is also very elevated implied volatility, so it makes it a little tougher to just go out and buy calls, but somebody started buying some calls, it looks like today, on the 25 strike. So others are still looking for that opportunity on the bounce back. May or may not work in the very short term, but over the course of time here, and if the market is bouncing back, I think it will, you know, off of market beta. It's like a leveraged market beta. It's almost like trading, was it T? Yeah. Almost feels like trading TQQQ, you know, where you got, well, TQQQ is even lower volatility technically. You know, QUBT is got about twice the volatility of TQQQ, but you know, to get a little bit of leverage on the bounce back, that's kind of the idea, is effectively looking for either high volatility tech names that get chased into, or going into like a leveraged ETF if you don't like to trade calls, you know, or you don't have a strong opinion on the implied volatility, then just trading TQQQ gives me the leverage exposure without having any technical Vega exposure. It's just all about realized movement potential for the day. I could see this getting back up to like 102 today, 2%. You know, get a little green. Oh, all right. I think that's about what I got for today. It's about 10:30 anyway, so I will let you guys go here. I think gun to my head, like I said, if I'm looking for a bullish trade, I can go to Micron 160, 165. Or Bank of America for a safer bullish trade in out in October 17th, 51.54.5 call vertical. And for looking for something a little bit safer, very short term, 655, 654 put credit spread in SPY. Holding for a few days longer, it could go into MDT or just, I mean, honestly, going with the Micron 155, 152.5 foot credit spread for tomorrow. That's not very long term, but it still collects now 40 cents. So nearly a 20% return on risk. So it's kind of line up pretty well right now for the dip buyer. See how it goes. Thanks again, everybody. I will see you tomorrow at the close. Vlad will be on close today, I believe, and open tomorrow. So he can correct me if the market ends up down 1.5% and tell you how to fix my thought that the market was going to bounce back. So hopefully it continues, but if not, just watch that 655 level in SPY in particular. If we drop back down to being down 1%, we're getting into the danger zone. Okay. Thanks again, everyone.